Yeah, this is a broadcast we're doing. I think we did one today, but it didn't turn out very well, so we're just doing it again. Today, what we want to talk about here is support and resistance lines, and of course, what are trend lines? What are trend lines? Before we start, we'll just put up this notification here. It's just a disclaimer. Basically, forex and leverage instruments are highly risky products. You could lose more than you invest. The opinion shared here and not one of a financial advisor. If in doubt, please seek financial advice. That is what we would advise. We do not claim to be a financial advisory body. But anyway, we are giving tips here that you can actually find out for yourselves, find out the efficacy of them. Ultimately, this is a live chart. This is the Euro Australian dollar chart. And ultimately, as traders, what we are really interested in is to know whether the price action is about to turn. If the price action has topped out or it has bottomed out, either is about to turn at the top of its current move if it's an uptrend, or it's about to turn at the bottom of its current move if it's a downtrend. Hence the advent of support and resistance lines and trend lines. But what are support and resistance lines? Let's define it. Fundamentally, a support line, a line of support, refers to a low point or a low area in the price chart below which price is not expected to exceed. For instance, just to give an example, we have this black line here. We've just drawn it arbitrarily there. That is considered to be a support line because it forms a line at the low bottom of this, at the bottom of this current action of price from there to there, below which price actually did not exceed. So that's the general idea of what a support line is. A resistance line, on the other hand, is the opposite of support. It's a high level where price is above which price is not expected to exceed. So we've just drawn that black line there, and that is a resistance line. It's a turning point for price moving upwards, while the support line is a turning point for price moving downwards. Okay, so that's the idea of support and resistance. Now, trend lines. Trend lines are basically lines that identify the trend, simply put. Okay, they identify the trend, but in doing so, they also act as either support or resistance lines. They act as support lines for to price that's moving in the upwards direction. For instance, if price that green line going up there, that's a trend line. That's a trend line, and it has acted as an area of support for price going upwards. And at that point, the where price touched it and then bounced off and moved upwards, it acted as an area of support for price. But also this green line coming down that way, that's a downtrending line. That's a trend line, identified downtrend. Again, notice how it has formed resistance lines, area of resistance for that, for the action of price going down. Each time price tried to rally, it rallied, touched it, came down, rallied, touched it, and came down again. And rallied and touched it, and came down slightly before it went up, touched it, there, came down, and then broke it finally. Now, this is what a trend line is, just a line identifying the trend. Now, the most important thing for the trader to know is how to draw the trend lines, or how to draw the support and resistance lines. Now, trend lines, for starters, the fundamental rule to drawing trend lines is you must draw them such that it touches 2 points. You must touch it's got to touch a minimum of 2 points and then a confirming third. Okay, a confirming third. So the basic rule is that it must touch 2 points and a confirming third. Now, you know, that's the rule. But here at Equity Trading Network, we slightly modify that rule a bit, that the minimum points it must touch 3 points, you know, as a minimum. So when you draw your trend line, you must look for it to touch 3 points for it to be a valid trend line. A valid trend line meaning when price actually breaks or closes above the trend line or below the trend line, it will have a significant movement up or down, depending on the direction in which the trend line is identifying, either a downtrend or a uptrend, or like a sideways movement or whatever. But it must touch 3 points. That's our rule here at the Equity Trading Network. So basically, this green line here going down is more of a valid trend line than this green one going up there, because you can see they started there, touches, there's 1 point touch there for that price movement up, touched the green line there, came down, rallied, touched it there, second point, third point, touched it up there, fourth point, touched it up there, and then we've got several touches, not just 3 but 5. So so a minimum of 3 point touches for the trend line, meaning it could be more than 3, but 3 is the minimum for it to be a valid trend line. Okay, now when we talk about trend lines, and there's so many information out there in books and in webinars and things from very, very skilled people who do this trading training courses. They tell you that it must touch 3 lines, 3 points or 2 points and a confirming third. And when they draw the trend line, you're of the impression that the trend line must touch on one side of the line, in other words, to identify it as either an uptrend or a downtrend. In other words, this is an uptrending move there, and therefore when you draw a trend line, the tendency is for you to look for it to touch 3 points on that side of the line for it to be a valid trend line. Or if it were a downtrending line like that green one from there to there, you look for it to touch 3 points on that side of the trend line for it to be a valid trend line. However, our experience here shows that that is not necessarily the case. Our patterns still follow the recommendations of trend line touches, minimum of 3 points, our recommendation, but we actually find that a trend line can actually meet that requirement on one side of the line, or either or both sides. So basically, you would have a trend line where the line actually comes, the price actually touches that line. It might break it a bit, but then it goes back to retouch it to form either the third point touch, and then before it begins to go down. So this is how we actually validate trend lines. So in this trend line here, for it to be a valid trend line, this move here, right? This green line going up there, right? Now you can see price has just broken it. Now for that price break to be a valid break, we need this trend line to be valid, because right now what we've got is just 2 point touches. We need that trend line to be valid. It has to come, price has to go back and touch it again and then begin to go back down, then it would have validated that trend line, and we'll know that price is definitely on the downside. But as it is now, yes, there's a break of that trend line, but this is probably too late in the day to get into the into this trade. Yeah. All right. Now we'll look at the other principle I just talked about for price meeting the 3-point touch minimum requirement on either side of the line. Now, if you look at this red line here, that's a trend line. Believe it or not, that is a trend line, basically. It's a valid trend line because the touches of price, because we're using it to study the movement of price at this point here, which was upwards. So what we wanted to find out was what was the condition of price at this point here, where there had been so many drops. What is the actual condition of price? So we wanted a line. We wanted to use the validation of a trend line to determine that. So we drew a line, and we can find here that that line was expected here as a support. Here it broke down slightly, came back, touched it as resistance twice, actually, 1 and 2, and broke down finally, and came up to here, broke it upwards, and then came back and touched it again as support. Came back, came all the way up to the 1.5 area, 1.52 area, retraced back down and touched it again as support. So we have support, support, resistance, resistance, support. You know, it has been challenged as resistance and support several times. So that is a valid trend line. Now, when the price broke here, when the price actually broke that red trend line there, it bounced back to test it again, slightly in just one candle move. As you can see, the one blue candle move. It went back and tested the red line again, proving that that was a support line. Now, at this point in time, the candle, proving that that was a valid trend line, I beg your pardon. Now, the candle now, the next candle closed significantly downwards, and that would have been a call to get into a trade, which obviously by now would be in a profit at this point in time. However, the move might not last very long because, again, a further trend line has been broken, and it needs to be validated. That trend line needs to be validated. By so doing, we've got only 1 2-point touches. We need a third, which obviously will come in the retracement of that move, touch it, and then or attempt to touch it before it begins to come back down. Then we'll know that that move there is actually continuing. But this is how trend line, valid trend lines are. Well, however, trend lines are not just valid in themselves. Trend lines aren't just valid in themselves. In the sense that, by that I mean, trend lines are not just the only tools you need to know to be a successful trader, but they do form, in the toolbox of techniques and tools. They do form a very powerful method when combined with other methods, which I'll briefly explain here, to determine the direction of trend and where the chances are that price is actually going to turn. Right. If we come here, I mean, this is obviously proving the point again. I mean, yeah, you got 1 2 3 touches there in this red trend line, and of course, when price came bounced off it, call that 4. Eventually, when it broke it, it actually went through. It broke that line, went back and retested it. Actually, if you were to draw that line again, if we were to extend it, you'll find that that was a retest of that line. Okay, if we extend that, so we have 1 2 3 4 touches already, and then we've got a 5th one. It broke it, it retested it at 5. That is validating that line as a real trend line. So at that point, where that red candle closes there, that one there would have been a very good point to enter the short trade, and reading it down up to that point there. But then again, candles, trend lines, like we said, are not the only tools that you need to be successful, to be a successful trader. In fact, if you depend on trend lines in that fashion, you might get nicked seriously. This is an example of the fact here. Here is a trend line that's actually done very well, identifying itself as a trend line. Okay. The price has actually done very well identifying, validating that as a trend line. But then again, you see where price, uses that as a resistance, comes down, support. I mean, there's a head and shoulder formation here. Support, just touching that line. Here again, support comes down here, barely uses it, just hovers around that line, resistance, comes back down and touches it here as resistance, and then breaks it. Okay, we've had several touches already. 1, 2, 3, 4, and then there's a fifth one, and then it breaks it to the upside. But then what happens? It begins to retrace. This is where we know that price is not, the trend line is not, this is just proving the trend line is not necessarily all there is to trading. To be a successful trader, you need to validate the trend line with a bit more information. Okay, and that is what we would like to just briefly touch on here. Subsequent webinars and live broadcasts will touch on how you can actually, validate a trend line. But I'll show you briefly here. Now, a lot of people have criticized momentum indicators, and I think this is largely because they do not understand or know how to use them. Now, on this chart, you can see there are just 3 momentum indicators, not modified whatsoever, with their standard configurations, and that will do just fine. Okay, that will do just fine. We are not modifying them. We're not introducing robots or anything like that. We're just trading the markets with good old tools, and we'll see how very effective they are actually. Now, we have the ones I want to pay attention to is the ATR, average true range, and the relative strength index. Those are the 2 I want to pay. We'll talk about that later in another webinar where we look at other momentum indicators. But this is the relative strength index and the ATR. Okay. Now, the importance of having the trend line on the chart, identifying the level of trend on the chart, is that we are building a set of rules for ourselves, for a set of psychological rules for trading, for getting into a trade. Okay. Now, those rules only become reality, or they provide us with a definite opportunity to get into a trade only when the price actually the price breach of that particular level identified by the trend line or the support and resistance line, only when that breach in price is supported by the momentum indicators. And I'll show you here. Here we've got the RSI. Pay attention to the RSI. At this point where we had a false breakout of that trend line, it was a false breakout in that sense. The RSI here was showing us that the RSI and the ATR were showing us that that could probably be there could probably be a trend reversal actually at that point. Now on the RSI, you see there's a green line there within the RSI, and then there's a red thick line at the bottom there. There's also two green areas there, lines at that point, and then the red one. Now the green line at the top, that shows that has been drawn, and how that's drawn is a topic for our advanced classes, and you might want to consider looking at our advanced courses to know exactly how these things are done, because they will do you good. But you will see now. I'll show you exactly what I'm saying here. Now the green areas, that top line, the top green line, is actually an area that has been drawn and identified as a momentum top out for the relative strength index when price is in an uptrend. Okay, I'll say that again. It is the area. This is the area of resistance for the RSI, the green area, not the red, the green one is the area of resistance for the RSI when price is in an uptrend. And the bottom green lines, green zone here, is the area of support for the relative strength index when the price is in an uptrend. So the green lines are uptrending information. The top green line, resistance in an uptrend. The bottom green line, support in an uptrend. The red lines you see on this chart on the RSI are downtrend information. The top red lines are resistance areas identified when price is in a downtrend, and the bottom red area is support zones when price is in a downtrend. So red lines, downtrending information, green lines, uptrending information. Now, we notice that whenever RSI approaches any of these lines, or actually is within any of these lines, or is on any of these lines, and the ATR, when we look at the corresponding ATR for that level, is actually spiked upwards, it means that there will be a reversal at that point. The extent of the reversal, this is what we found here in our equity trade network. The extent of the reversal is dependent upon other factors which we will discuss in other webinars. That is the strength of the reversal and how violent the reversal will be. So we see those information and we do not take action on them simply because the candle is green and is really full, powerful green. We do not take action. We wait. So these momentum indicators, depending on how you use them, they are very, 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 very useful indeed. You need to see these things. You need to follow these things. You need to know these things because it will help you make very, very good decisions, which you will be very, very happy with. Now, let's look at this. At this point where the price actually broke our very valid trend line, RSI was just at the resistance level for RSI when price is in a downtrend. And guess what? ATR was spiked up. That meant that we were not meant to take that trade, and that was not a valid break. It was a false breakout. That's how we identify false breakouts. And of course, price retraced. Now let's look at what happens when price actually breaks any of these lines. When the RSI actually bounces off any of these lines, or actually goes past them or breaks them. What happens in those scenarios when it bounces off any of those lines and then goes past them, and then ATR is actually spiked up? That is a signal for us to get into the trade when the RSI actually has breached some of the these levels. When it bounces off the green, the bottom green level, which is one of the area reserved for support of price, when support for RSI when the price is in an uptrend. If it bounces off that and ATR actually at the point in time of the bounce, at any point in time of the bounce points upwards, then we do have an uptrend. We do have a move. Okay, we have a move upwards we can take action on in terms of a trade. Okay, so basically when RSI approaches any of those resistance zones, any of these lines, and ATR is spiked up when RSI is in the zone of any of these lines, that is probably trouble, saying, price probably is going to reverse. But if it bounces off any of these lines and crosses any of them on its way down or up, and ATR is also spiked up, then it means that is a trade we should take. We should take it because it will indeed provide us things that we could be happy with. So this is how we know where support and resistance actually lie. Now, we can see several examples of this here. This is one of them. RSI is actually in the zone identifying a resistance area for price when price is in a downtrend, the red zone. And guess what? ATR is spiked up at that point. You can see the ATR. Just follow my cursor, and you see what I'm saying there. Right there, the corresponding value of ATR is, at that point there, is up. Just that little dink there up. It's spiked up at the same time. So this is how we know we're not taking a trade at all. Now here, if you look at this point there, RSI had bounced off. It's curving upwards, bounced off the bottom green line. Yeah, but ATR at that time was still kind of flattish. It wasn't spiked up. But then as soon as we moved into this one here, RSI was already spiked up. Okay, the ATR started spiking up. That was a bounce from the green line. Okay, so the bounce from the green line, yes, it was a bounce, and yes, it was getting close to that red zone, but it was a bounce, and it was getting to the red zone, and ATR was spiked up at the time. Yes, it was signaling that baunce was probably coming to an end, but then we would take that trade because the bounce was very soon. The ATR spiking up was so soon after the bounce actually happened from the green zone. So we'll take that in. Yes, there was going to be a brief stop, and it did stop indeed. But then eventually, when it broke that line, that red line there, guess what? ATR also was spiked up. ATR was also spiking up, and there was a call for us to take a trade. So anyway, until it got to the green zone where ATR also stayed spiked up, and then we had to come out of the trade at that point in time. Okay, ATR was just spiked up there. But this is how we identify what is actually happening in the markets with the our psychological levels we have identified. I mean, with that in mind, we can see that current levels in price is current RSI levels in the price of the Euro Australian dollar is showing us that yes, there was a spike at this point. RSI has crossed the green zone, crossed the green zone with that big candle there. Okay, cross the green zone with that big candle there. You can see RSI. You can see the corresponding dots as I over my cursor on the green on the red candle, the big red candle there. You can see the corresponding points down there. It has breached the green area down here. It has breached that green area, and ATR was spiked up at the time. ATR was pointing upwards. Basically, that's what I mean by spiked up. It was pointing upwards, ATR. It doesn't matter where the general direction of ATR is. It could be downwards this way, but what we're interested in is the little contours that are made in ATR when these phenomena that is actually taking place in RSI and in price. And in this case, yes, ATR was moving upwards, but it was also spiked up. At the time RSI was crossing that bottom line for the resistance, so for the support for an uptrending market. So basically, our price, that told us that it was a time to get in short, and we did. And this is what is happening to price. It is actually continuing its movement downwards. We won't get out of this until maybe ATR begins to spike up as RSI begins to approach this red support zone reserved for the support zone for a downtrending market, we'll not get out of the trade, we'll stay there. But as soon as ATR begins to spike up on the close of the day and RSI is close to that support area, we'll take off we'll take the trade off, because we're looking for a reversal at least up to that trend line there to give it validity before a further breakdown. So this is how we validate levels of support and resistance, and this is what support and resistance is and what a trend line is. Remember, a trend line is just a line identifying the trend, and the way you draw it is to really find a minimum of 3 points, 3-point touches on either side of the line. The total touches, point touches, can be a combination of both sides of the line or on one side of the line. If you've got benefit of having it on one side of the line, all the better. That means a valid trend line, an easy one. But if it isn't, you can find other means. You can test other variations of the trend line that have actually had lines touch it, use it as support and resistance on either side of the line in such a combination that they form a minimum of 3 touches. Three touches as support and resistance will validate a line as a trend line. And then you can use your momentum indicators to determine whether a price breach of that line is actually worth taking or not. So this is where we would leave the presentation just now. We'll leave the broadcast here. We would be back again tomorrow, 10:30 a.m. For the broadcast on other means of finding support and resistance. And of course, we might touch on candlestick patterns as well. Might touch on candlestick patterns as well, because some of these things are quite necessary. But anyway, I hope to see you guys next time, probably tomorrow at 10:30 a.m. And until then, happy trading.